Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is George Milling-Stanley. He's the Chief Gold Strategist with State Street Global Advisors. We're going to take a look at gold ETFs, and they'll continue to shine in 2020. We're also going to discuss the role of gold in today's multi-asset portfolio. George, it's great to have you with us. Thanks so much for joining me on Trade Talks.
Thanks for inviting me, Jill.
All right, now let's talk about the IPO of gold. I think we're so used to trading and investing in it, we don't even look at it in terms of when it IPO'd.
Yeah, it's a phrase that one of my colleagues at State Street coined. He was looking back at 1971, which is when President Nixon ended the automatic right of foreign governments, foreign central banks, to exchange their dollars for gold. That was depleting our gold reserves dramatically, with many governments taking advantage of this right. And so he stopped that. He closed the gold window, in the phrase. And really, that was the birth of the free market in gold. Before that, gold and money had been inextricably linked from the dawn of history onward. So I think we really only had a free market since then. So I think calling it gold's IPO is really a very relevant way of looking at it.
All right, and let's take a look at correlations between gold and equity and bond indices since 2000.
Yeah, for most of my career in gold, which actually goes back to about the time of the IPO, we've been looking for more or less steady inverse correlations between gold and equities, and between gold and the dollar, for that matter. In other words, in periods when equities were strong, gold was frequently weak, and vice versa, and similarly with the dollar. I think the global financial crisis of 2008 changed a lot of things, and I hesitate to say this time it's different, because those are often the four most expensive words in the English language. But I think that we really did see some changes since 2008, or rather since the recovery began in 2009. We've seen that equities and fixed income stocks, bonds, often move in the same direction, as they did in the early part of this year when we had the big drop in stocks. So that you're not getting the same kind of protection from equity weakness in the bond market that you used to. But gold, I think, by contrast, when stocks are going up, gold can go up, down, or sideways. It's shown an ability to do all three of those in the last 10, 12 years. But every time stocks have turned down, sometimes there's a very quick response in gold to go down as well if people meet unexpected liquidity needs by selling some gold. But typically, shortly thereafter, gold will recover and gold will move on up and go on to new highs. And I think that's what we saw in the early part of this year. It's what we saw in the global financial crisis of 2008, and it's what we saw in the recession of 2002, and indeed all the way back to 1987, Black Monday. So we've got a very different kind of relationship. Instead of a relatively steady inverse correlation, you have an asymmetrical relationship. The inverse correlation only kicks in when equities move down. And personally, I'm afraid that we haven't seen the end of weakness in equities yet. The recovery, the rally has been very dramatic, up 30% within a few days, just as dramatic as the decline was. And I'm rather suspicious. I'm afraid we might see another downturn in the equity market, another downward leg.
Yeah, I think many people would agree with you. The velocity of the moves has certainly been a challenge when trying to determine, are we over the hump? Could we get a second wave? It certainly is challenging for portfolio managers to determine where are we going to put their money. So let's think about that now from the lens of a portfolio manager. And on the slide, we could see a hypothetical portfolio. What does the correlation look like to other asset classes?
Basically, gold doesn't have a strong statistical relationship with anything else you'd expect to find in a typical portfolio. So no strong statistical relationship with the equity market, not on a consistent basis, although, as I say, that negative correlation does kick in if there's a sudden and unexpected big downward move in equities. No real correlation to the bond market at all. There never really has been much of one. And not really a strong correlation to things like real estate or private equity or hedge funds. Not even the commodity complex. It's not really a strong correlation at all. So I think that gold is giving you a level of diversification that few other assets can match.
All right, George, and to wrap up here, what's the most cost-effective way to invest in gold?
I think a lot of investors have voted with their wallets. It's what they tend to do. We have seen something like something over $100 billion have flown into gold ETFs since we launched the first one back in the US in 2004, GLD. GLD itself is a $61 billion asset right now. That means $61 billion worth of shares outstanding on the New York Stock Exchange, $61 billion worth of gold backing that up, sitting in the vault in London. So that has been a very popular vehicle. We've actually seen inflows this year alone of more than $12 billion, net inflows into GLD. And I think that's really quite extraordinary. It accounts for about 2/3 of all of the net inflows into all of the gold ETFs in the US. GLD's little brother, GLDM, the mini product with a lower share price, has already attracted just over $2 billion in less than 2 years of existence, and has already attracted almost $800 million year to date. So I think that there's really no question that investors have decided for themselves that gold ETFs make sense.
All right, George, great to have you with us as always. Thanks so much for joining.
Thank you, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.